Okay, macroeconomic students, Professor Lewis here. This is going to be a short but sweet video about price ceiling, price floor, and how the government, with good intentions, trying to regulate price but ignoring costs of production and desire to buy, ends up causing the market to fail and not clear to a proper equilibrium. So we're going to go ahead and share the screen. We're going to the last slide, okay, of the power slideshow called market theory. And so we're going to zoom on in and take a look at this thing here. All righty. There are two kinds of price barriers that exist. One is called a price ceiling. The other is called a price floor. A price ceiling is a legally imposed maximum price placed in a market, while a price floor is a legally imposed minimum price in a market. Now, down here on the bottom of this slide, we've got market diagrams that show each type of price barrier. First of all, let's talk about why the government establishes a price ceiling. Left to its own devices, what we see up here is P star, which is the natural equilibrium price of the market, and Q star, the proper equilibrium quantity at that price. What typically tends to happen is the government looks at this market and says, you know what, that P star is unfairly high for some consumers, low-income consumers especially. Now, an economist would say, well, there's two things you can do. You can either stimulate supply, like if there's an excise tax, stop charging it. If the industry is overregulated, regulate it less. There's a number of things that could be done, offer a subsidy to stimulate production, shift supply to the right to drive prices down. The other possibility is discourage consumption. Try to encourage consumers to find ways to prove that they're using less of it. Strongly encourage them, maybe with some legal regulations, to use less of the product. And if the demand shifts left, the price will drop. The problem is the government doesn't listen to economists. The government just says, we are the law, like old Judge Dredd. And they say, we think P sub C, which is noticeably lower than P star, is the maximum price that should be charged. Any price less than or equal to that P sub C is legal. What I'm circling around here is the legal price range. So there's a problem. Supply isn't going to shift. Demand's not going to shift. And in fact, the market won't clear at equilibrium anymore. If you follow P sub C, the first thing you'll notice is the quantity supplied at the ceiling is now below the original equilibrium. Businesses have to avoid losing money. If they can't make a profit, they should at least break even. And so in order to do so, if that price is too low to cover costs, they're going to cut back on production, probably lay off some workers in the process, I might add, which doesn't help either, I might add, and produce a lot less of the product. It's going to become more scarce. But at the same time, if you follow P sub C over to the demand curve, notice the quantity demanded at that equilibrium is now a lot higher than it was before. This P star, the equilibrium price, serves a rationing function, and probably because it was high, there's a lot of people who were conservative in their usage of the product. But now that price is forced down to a much lower level, they're going to want to consume more of it, but they're going to be angry because the product is more scarce, even though it's cheaper. And they're going to want to use more of it, but they can't. And they'll start screaming conspiracies. They'll demand the government ration the product and this and that and the other. But the effect that the government is causing here, where the quantity supplied is less than the quantity demanded at the ceiling, is called a shortage. Class, what happens before a hurricane when there's an enforced price freeze on gasoline and water and stuff like that is not a price ceiling. Main reason why it's not, those products that were bought and on the store shelves before the hurricane, they were not affected by the hurricane, and their cost of production and cost to sell have not changed. Businesses should be advised to limit the quantities people can buy, like a lot of businesses did before and during Hurricane Harvey and afterwards, but they should not be jacking the prices up to $7 a gallon for gas. That's not reasonable given the cost of the gas that was in the pumps. No, the examples we have is that there's a rent control clause on some apartments in New York City where if you move into an apartment that's subject to rent control, the landlord can never raise your rent. So you can live in that apartment for 20 years and the rent never goes up. That's great if you don't move, but it's lousy if you want to move, because what ends up happening is it's going to be more expensive to find a newer apartment because the free market apartments will be more expensive to offset the losses of the rent control clause. There's a price ceiling on interest rates on credit cards, 30%, actually 35%, excuse me, is the maximum interest the government allows any bank to charge on a credit card. And this was passed in 2009 because of banks preying on people with bad credit or with little credit experience. The problem is it creates a shortage of available credit. Some people had their credit cards closed, some had their credit lines lowered because of the fact that the interest rate was lowered to a more reasonable level in the government's eyes. But banks decided, you know what, this is risk-based pricing. People with bad credit shouldn't have credit with us. And then if we can't charge, say, 80% interest as opposed to 35% APR. And so this has made a shortage of revolving credit. Now, a price floor is the opposite. Like we said, it's an illegally imposed minimum price in the market, and the government establishes it because P star, in the government's eyes, is unfairly low for certain suppliers. You could say small businesses. If you're talking about labor resources, people with low-level service-oriented labor skills. They think that this equilibrium price or equilibrium wage rate is too low for workers, and they think that this piece of F or higher, notice where the legal price range is what the lowest price should be. Any price higher than that's fine. Below it, including equilibrium, not allowed by law. There's a problem with this, though. If you push the price too high, and again, you're not addressing cost of production, you're not desire to buy or employ, look at what happens. Follow P sub F to the demand curve. Notice the quantity demanded of that product or resource is now less than it was before. If this is labor, fewer people get a job at this artificially high wage rate. If it's a product like milk, people buy less milk at that artificially high price. But at the same time, at least initially, that price floor being set so much higher than the equilibrium, a lot more people with low-level skills look for work, but they find fewer jobs. Dairy farms produce a lot more milk, but a lot less of it's going to be sold. The quantity supplied is above equilibrium and is far above the quantity demanded. If quantity demanded is below quantity supplied, we call that a surplus, meaning there's excess production. If it's a product like milk, it means there's too many workers, not enough jobs, and we have unemployment, specifically induced unemployment, as a result of the minimum wage rate. And like I mentioned, there's a wholesale price floor of 99 cents a gallon for raw milk to be sold to milk processing plants. A small dairy farm that sells 500 gallons of milk a week will get the same 99 cents a gallon as a big corporate farm that produces 5 million gallons of milk per week. That is the minimum price allowed by law on wholesale raw milk. The minimum wage rate of $7.25 an hour at the federal level, but it could be higher based upon the state or the city, is designed to be a minimum standard of living, but that's not really how it was designed. It was intended to be a training wage for somebody who has no skills to develop skills, and then later on advance and move up. And so given the fact it's a training wage, if you're offering somebody $15 an hour, or you have to pay $15 an hour for somebody to flip burgers or front and face cans of chili in the store, you're going to hire a lot fewer people to do this because labor is one of the most easily controlled costs in the short term by a business's management. And the problem is charging too high of a price for labor or being forced to pay too high of a price for labor is going to lead to cost overruns. It's going to drive prices up. It's going to actually have a whole bunch of negative impacts. Now, saying this here, I do realize that trying to live on $7.25 an hour is very difficult. But a lot of people in Houston are paid $9 to $12 an hour for what we consider minimum wage jobs because here the demand for these kinds of skills is a lot higher than in other cities. But in every city that has went to a $15 per hour minimum wage rate, San Francisco, San Jose, Seattle, what has ended up happening is people have gotten laid off. Or if businesses raise their prices to offset the increase in wages, the businesses have failed because the customers don't want to pay those high prices for the goods and services that would support the wage rate. Bottom line, if that wage rate is being pushed on businesses is above equilibrium, it will cause unemployment, or maybe businesses will resort to dealing with illegal labor practices, such as illegal internships, where people aren't paid to do work that should be valued at a certain dollar per hour, or they may hire illegal immigrants and pay them cash and pay them less than the minimum wage, and they won't complain because they're happy to have the job. I'm not saying that there's an easy solution. There isn't, but this is the reality of price ceiling and price floor. So, okay, Alt tab here. Let's go ahead and let's stop sharing. Pardon me for a moment. All righty then. So in conclusion, I'm not saying the government has bad intentions when it sets price ceilings and price floors. What I'm saying is if they don't try to figure out proper ways to get prices higher or lower, which is moving supply or moving demand, it's not going to solve whatever problem they think they're solving. Thank you all very much and have a great Sunday.